TSMC just delivered another record quarter. But the headline numbers may not be the most important part of this earnings report. The real signal came from what management is doing next. TSMC is raising capital spending to as much as $64 billion, expanding advanced manufacturing capacity, and committing another $100 billion to the United States. That is a massive capital allocation decision. And it raises a much bigger question for the entire technology industry. Is TSMC simply benefiting from the current AI boom? Or is the company telling us that the AI infrastructure cycle is becoming significantly larger, and potentially longer lasting, than the market expected? Because if demand for advanced chips continues to grow faster than the industry can build capacity, the next phase of the AI boom may not be defined by who designs the best chip. It may be defined by who can actually manufacture enough of them. And right now, TSMC is positioning itself at the center of that bottleneck. The numbers immediately explain why TSMC remains one of the most important companies in the AI ecosystem. In the second quarter, TSMC delivered another record performance, with revenue reaching approximately $40 billion and net profit surging 77% year-over-year. But the more important point is consistency. This was not an isolated quarter of growth. TSMC has now delivered 9 consecutive quarters of double-digit profit growth. That tells us something important. The current AI cycle is no longer simply creating demand for advanced chips. It is creating extraordinary financial results for the company that manufactures many of the world's most advanced processors. But earnings are backward-looking. Capital expenditure is forward-looking. And this is where the latest report becomes much more interesting. TSMC raised its 2026 capital spending forecast to between $60 and $64 billion, with the majority directed toward advanced technologies. This is a massive commitment. TSMC is not simply responding to today's demand. The company is building capacity for demand that management expects to continue for years. In the semiconductor industry, capital expenditure is one of the clearest signals of management confidence. And TSMC is sending an extremely strong signal. The most important constraint in the AI semiconductor industry may no longer be demand. It may be supply. Demand for leading-edge process technologies remains extremely strong, while advanced packaging has become an increasingly important bottleneck. This creates a very unusual situation. Customers are not simply asking for more chips. They are competing for access to the manufacturing capacity required to build the most advanced AI systems. That is why TSMC is investing aggressively. The company is trying to expand capacity before demand becomes even larger. One of the most important changes in the AI industry is that demand is becoming broader. The AI infrastructure market is no longer simply a story about one GPU company. Hyperscalers are designing their own custom chips. CPUs are becoming increasingly important in AI data centers. New AI accelerators are entering the market. And these different processors increasingly require advanced manufacturing and packaging. For TSMC, this creates an important advantage. The company does not need to predict which individual chip designer will win. If multiple companies compete to build the future of AI computing, TSMC can potentially manufacture for many of them. This is where the TSMC story becomes strategically powerful. The company is not dependent on one specific AI architecture. Its customers can compete against each other, while TSMC supplies the manufacturing platform behind them. NVIDIA can grow. AMD can grow. Hyperscalers can design their own silicon. New AI companies can emerge. From TSMC's perspective, the winner of the chip design competition may be less important than the continued demand for leading-edge manufacturing. This gives TSMC exposure to the growth of the entire advanced computing ecosystem, rather than exposure to only one individual product. Strong revenue growth is impressive. But strong growth combined with extraordinary profitability is even more important. In the second quarter, TSMC reported a gross margin of 67.7% and an operating margin of 60.3%. These numbers demonstrate the economic power of advanced semiconductor manufacturing. TSMC is not simply adding volume. It is monetizing scarce technology and scarce capacity at extraordinary margins. This is one reason why the current AI cycle is financially different from many previous semiconductor booms. The company at the center of the manufacturing bottleneck is also capturing a significant portion of the economics. The AI industry is now entering a more capital-intensive phase. Building AI models requires more computing power. More computing power requires more advanced processors. More advanced processors require leading-edge manufacturing. And leading-edge manufacturing requires enormous capital expenditure. This creates a powerful feedback loop. As AI infrastructure expands, demand for advanced semiconductor capacity increases. But the same process also creates risk. The industry must spend billions of dollars before future demand is fully guaranteed. And that brings us to one of the most important questions facing investors. The biggest risk is not that TSMC cannot build enough capacity. The bigger risk is that the industry eventually builds too much capacity. Semiconductor history is full of cycles where optimism leads to aggressive investment, followed by excess supply. TSMC is clearly aware of this risk. The company sees strong demand, but customer forecasts are not guarantees. This is why the current capital spending cycle is both exciting and dangerous. TSMC is making a massive bet on the duration of AI demand. And the longer the company expands capacity, the more important that assumption becomes. The second major signal from this earnings report is geographic. TSMC announced an additional $100 billion investment in the United States. This is strategically significant. Advanced semiconductor manufacturing is no longer only a commercial issue. It has become a national security issue. TSMC is therefore expanding its manufacturing footprint beyond Taiwan, despite the higher cost and complexity of overseas production. Economically, this may create challenges. Strategically, however, it strengthens TSMC's position as one of the most important semiconductor manufacturing partners for the United States and the global technology industry. The latest earnings report changes the investment debate. A year ago, the question was whether AI demand was real. Today, the evidence is much stronger. TSMC is reporting record results, raising capital spending, and expanding capacity because customers continue to send strong signals. The question has now changed. How long can this demand continue? And can TSMC build capacity fast enough to capture it without creating excess supply? The answer to those two questions may determine the next phase of the entire semiconductor industry. TSMC's latest earnings report tells us much more than the story of another quarterly beat. Revenue is accelerating. Profitability remains extraordinary. Demand for advanced technologies is still strong. Advanced packaging remains a critical constraint. And management is committing more capital to expand capacity across the world. None of this guarantees that the AI boom will continue indefinitely. But it does tell us that the companies closest to the semiconductor supply chain still see a multi-year opportunity ahead. The biggest question is no longer whether TSMC benefits from AI. It is how large this cycle can ultimately become. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.